He didn't just reshape economics, he reshaped how nations understand fear, authority, and the meaning of money itself. John Maynard Keynes wasn't a politician or a street-marching revolutionary. He was something rarer, thinker, whose ideas could steer entire governments away from collapse. He taught countries that sometimes the only way out of darkness is to spend your way forward. For centuries, public debt was seen as a moral failing. Balanced budgets weren't just a good idea, they were a badge of virtue. Keynes completely flipped this thinking. He argued that spending during a crisis wasn't wasteful. It was responsible. Borrowing wasn't a sin, it was a lifeline. This one philosophical shift would rewrite modern history. Begins in the rubble of the Great Depression. The old economic rules promised the system would fix itself, but it didn't. The world froze. Keynes saw the problem wasn't laziness. It was a collapse in demand driven by fear. And from that insight came a revolution. Keynes recognized that recessions were not natural purges that cleansed excess, they were failures of circulation, failures of spending. When people panic, they save more. When everyone saves at the same time, spending collapses, and when spending collapses, incomes fall, leading to even more saving. What makes sense for one family becomes destructive for an entire country. To this was the paradox of thrift, individually rational, collectively ruinous. One person's spending is another person's paycheck. When spending dies, the economic heartbeat flatlines. Keynes proposed something radical. For his time, if private demand evaporates, public demand must replace it. Government should borrow higher. Workers pump money back into the system. This spending creates jobs. Jobs create income. Income restores consumption. And consumption restarts the stalled engine. Traditional economists were horrified. Government interference was taboo. Debt was dangerous. Balanced budgets were sacred. But Keynes argued that timing mattered more than ideology. Spend aggressively in downturns. Save aggressively in booms. Intervention and restraint in rhythm. He compared the economy to a car. The private sector drives most of the time, but when the engine stalls, the government must turn the key, inject fuel, and restart motion. In his 1936 book, The General Theory of Employment, Interest and Money, Keynes transformed these insights into a complete blueprint. Who introduced aggregate demand, the total spending in an economy, and showed that low demand, not bad workers or bad businesses, was the true cause of unemployment. This wasn't just math, it was psychology. Markets move with moods. Fear itself can freeze prosperity. Keynes understood that governments didn't just inject money, they injected confidence. Keynes's ideas did not gain immediate acceptance. In the early 1930s, most world leaders clung tightly to the old doctrine of austerity. Britain chained itself to the gold standard, strangling its own economy. Germany slashed public spending to prove financial discipline, only deepening social chaos. And in the United States, President Herbert Hoover refused large-scale intervention, convinced that markets would auto-correct in time. They did not. By 1933, a quarter of Americans were unemployed. Banks collapsed, wiping out savings. The market didn't heal, it deteriorated. The economic engine had fully stalled. Then came Franklin D. Roosevelt, not an economist but a political visionary, whose instincts aligned with Keynes's emerging philosophy. Roosevelt didn't call it Keynesianism, but the core idea was unmistakable. When fear kills private spending, government must spend in its place. Under the New Deal, the U.S. government launched an unprecedented array of programs, massive public works. Projects like the Hoover Dam and the Tennessee Valley Authority transformed landscapes and lives. The Works Progress Administration created jobs for millions. Artists, teachers, builders, laborers. The government became the nation's largest employer and customer, pumping wages directly back into the bloodstream of the economy. Slowly confidence returned, demand rose, with the economy began climbing out of the abyss, though haltingly and far from fully recovered. Ironically, the decisive proof of Keynes's theory didn't come from peaceful policy, but from global war. When World War II erupted, governments across the world did exactly what Keynes had been urging for years. They spent without hesitation, not to stimulate but to survive. Factories reopened overnight, where workers filled assembly lines producing tanks, ships, and planes. Nations borrowed on a scale once thought impossible, and the result was unmistakable. Unemployment vanished, production soared, incomes rose. Even amid destruction, economies roared back to life. It was the largest test of government-driven demand in history, and it worked. After the war, Keynes's ideas became the backbone of the global economic system. Bretton Woods, the Marshall Plan, European reconstruction, the rise of welfare states, all reflected the logic he had pioneered. The golden age of capitalism from 1945 through the early 1970s bore his fingerprints everywhere. The more governments used spending to stabilize downturns, the more they relied on it. Keynes insisted that countries should run surpluses during good times to prepare for bad ones. Politicians ignored that part. Voters liked stimulus, not restraint. So instead of saving during booms, governments spent in booms and spent in busts. Debt climbed. Discipline faded. By the late 1960s, inflation simmered. The system that once stabilized capitalism began to overheat. Then came the 1970s oil shocks. Gas lines, soaring prices, and stagnant growth created a nightmare. Stagflation, high inflation, and high unemployment at the same time. Something Keynesian theories said shouldn't happen. But the problem wasn't too little demand. It was an energy shortage that overwhelmed everything else. This crisis shook faith in Keynes. A new school, monetarism, led by Milton Friedman, argued that excessive government intervention and excessive money creation caused inflation. For a moment it looked like Keynes had been dethroned. But economic ideas rarely die, they wait for their moment. In 2008, global markets collapsed under their own excesses. Banks failed, credit evaporated. And instantly the world reached for Keynes' playbook. Massive bailouts, giant stimulus packages, central banks slashing interest rates to zero, quantitative easing, trillions of dollars created digitally and injected into financial markets. At first it worked, the system stabilized. Confidence returned, but the recovery exposed a new kind of distortion. Stimulus flooded financial markets instead of workers, stocks surged, housing prices exploded, inequality widened. Then came the pandemic, Keynesianism in overdrive. Governments sent checks directly to households. Central banks printed trillions overnight. Demand soared even as supply chains broke. For a moment it felt miraculous. Then the bill arrived, inflation roared back. The medicine that saved the patient also weakened it. Nearly a century after the general theory. Cause logic is everywhere. That is precisely the problem. Every slowdown triggers the same reflex: borrow, stimulate, inflate, repeat. The state has shifted from spender of last resort to spender of first resort. Politicians now use stimulus not to stabilize but to win elections. Deficits persist in good times and bad. Restraint has vanished. Yet Keynes' insight remains brilliant. Economies run on confidence. When people believe the future is dark, they stop spending, and when spending dies, economies die. Keynes offered a tool to keep belief alive. But today that tool has become a permanent addiction. Every crisis demands a higher dose. Markets no longer fear recessions. They fear the withdrawal of stimulus. Keynes once said, in the long run, we are all dead. Human government shouldn't sit idle while people suffer. But the quote became something else. A justification for endless borrowing and permanent, short-term thinking. The irony is stark. Keynes didn't destroy capitalism. He saved it, but in saving it, he made it dependent, more resilient in crisis, yet more fragile afterward.